Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 16th of December 2021. And we're looking at the Fed's FOMC announcement yesterday, plus the Bank of England and ECB's decisions today, and their impact on gold and silver prices. So let's take a look. Now, before we look at the Fed, ECB and BOE decisions, a quick shout out to this morning's video. Gold and silver update both jump after FOMC announcement, to which we place a link below. Now, at the time of writing this video, which is 17:30 GMT, we can see that the gold price is standing at $1,797, up some $30 over the past 24 hours, and some $41 above its week low of $17.56. And silver is up 93 cents at $22.50, $1.05 above its week's low. We are aware that many are surprised at this, as most of the headlines have indicated that the Fed was rather hawkish by increasing its bond tapering program and suggesting that there will be interest rate rises as soon as June 2022. So why the rise in gold and silver and the fall in the US dollar index, which is now down 0.4 at 96.12? Well, we need to dissect what the FOMC and Fed Chair Jerome Powell actually stated yesterday. Quote, "The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to keep the target range for the federal funds rate at 0 to 0.25%, with inflation having exceeded 2% for some time. The committee expects it will be appropriate to maintain this target range until labour market conditions have reached levels consistent with the committee's assessments of maximum employment." Unquote. Now, whilst some have regarded this statement as hawkish, and in addition, unlike in November's statement, it's also removed the sentence about adopting an accommodative stance on monetary policy, we shall see in a moment that perhaps this hawkishness is not that well founded, particularly as we could see jobless figures actually begin to increase. Now, the FOMC also announced that it would double the monthly reduction in the purchased assets from $10 billion for treasuries and $5 billion for mortgage-backed securities to $20 billion and $10 billion, respectively, meaning that the Fed will end its asset purchase program by March rather than by mid-year. In addition to this, the dot plot reveals that the committee sees inflation as more persistent at the moment, because they expect 2.6% PCE inflation rather than 2.2%, which they were originally forecasting at the end of 2022. And they predict core PCE inflation to actually touch 2.7%. In this regard, the dot plot therefore suggests that the FOMC will oversee 3 interest rate rises in 2022, 3 in 2023, and 2 in 2024, each rise being of 25 basis points, and rates therefore rising to 2 to 2.5%. So, on its own, this statement appeared more hawkish than analysts predicted. But listening to Jerome Powell's speech afterwards, one got the impression that they were adopting a more dovish tone than the actual statement revealed. In addition, little was also said about the Fed's existing balance sheet of over $8.6 trillion, which eventually will have to be pared down somewhat, especially when you consider that it only stood at $4 trillion at the end of 2019. Now, whilst this language initially appeared hawkish, without rates rising until June of next year, and possibly even longer, because Powell did state that it would be data dependent, even though the additional bond buying may be totally tapered and finished by March. There was no indication that rates would rise immediately afterwards. In fact, Powell went out of his way to suggest it was not a foregone conclusion. Now, this announcement caused both gold and silver to immediately rise after the announcement and have since increased their gains, albeit modestly. It was almost a situation beforehand of selling the rumour and then buying gold and silver on the news. In addition, we've seen today that the Bank of England has in fact raised interest rates by 0.15%, so they've actually taken the jump, thus raising the bank base rate to stand at 0.25%. The justification was an expectation of the central bank to see UK inflation, or its consumer price index, to top 6% in the coming months, and it needed to mitigate this early, as it could potentially lose all credibility if this was not contained. The pound sterling rallied as much as 0.8%, while UK 10-year yields jumped 5 basis points after the decision. Traders now see the Bank of England's key rate rising to 1% by September. So in other words, potentially another 0.75% rises. This, of course, contributed to the dollar index dipping in comparison in spite of a so-called hawkish statement yesterday. So many now forecast this rate in the United Kingdom to reach 1% by September 2022, and this should not be ignored. Clearly, the Bank of England has regarded inflation as more of a threat to the economy than the surging numbers of the new Omicron variant, even though firms are already asking for assistance due to various events and Christmas festivities being cancelled. In contrast to the Bank of England, the European Central Bank also announced today that bond buying under its €1.85 trillion, which is the equivalent of $2.2 trillion, Pandemic Emergency Purchase Programme, get your tongue around that, PEP for short, is due to end in March 2022 and will be cut next quarter as the scheme winds down. However, bond buys under the Asset Purchase Programme, or AP, will be ramped up to serve as a quantitative easing bridge through the end of the PEP, having continued at a monthly pace of €20 billion in conjunction with the PEP until now. Clear as mud? Well, on the one hand, cut back, on the other, increase. It also decided to keep interest rates unchanged. This, like the Fed, in reality sounded hawkish, but frankly was a rather light approach. Stocks generally in the UK and Europe have held up well, up 1%, whilst equities in the US are mixed, with the Nasdaq actually falling 2%, but other indices little changed. So where are we heading from here? Well, there is no doubt that there is still central bank stimulus going on into respective economies, but this, at least in theory, is being reduced month on month. Interest rate rises will occur, as we've seen at the Bank of England, but frankly they will be small and tempered. Whilst the UK's decision will strengthen sterling against the US dollar, the ECB's decision will weaken the euro further against that dollar. And as the euro holds a more dominant position in the basket of currencies against which the US dollar is assessed, this suggests a further strengthening of the US dollar on the dollar index once these figures have been fully digested. We suspect that gold, though, will hold on to its gains broadly, while silver may fall back again a little, if only until the outcome of the extent to which the respective economies will be affected by Omicron, resulting in any potential decrease in the industrial demand for silver, at least until that is known. Strictly speaking, we should see a strong tailwind for gold and silver, but with US retail sales being disappointing and other economic data like today's jobless claims rising, industrial production falling, and flash PMIs for manufacturing and services lower in December than they were in November, this does not augur well for a robust economic recovery. Our best calculation at present is that gold will move somewhere between 1850 and 1950 for the next week or so, and silver between 2150 and 2350. But we can get a clearer picture once all of this news has been fully digested, commented and analysed. and rest assured we will then give a more definitive price prediction. What do you think? Please share your thoughts. Meanwhile, thank you so much for listening. If you haven't already done so, do subscribe to our channel, not forgetting to press the bell sign so you're notified of our videos as and when they're published, and please look out for our morning update tomorrow. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.